So you think that even, within the next 12 to 18 months, it's going to get worse over there than it is now. Interesting.
Yeah. Not much. How are you?
I'm good. Kind of got a couple questions for you.
Yeah.
Well, I guess first of all, what's coming down the pipeline since I've talked to you? What's the word that you're hearing about where rates are headed, or what people are expecting these days? And then I got another question about Canton. But I'm going after a few properties that I've come across, and obviously I know that the rates are somewhat dependent on the properties themselves. But like, what are you hearing? What are you thinking here? Like, what is there anything that's changed since the last time we've spoken?
Well, I'm actually at a conference in Vegas the last 2 days, and it was just kind of the West Coast Lenders Conference.
Okay.
So for the past 2 days, every 30 minutes, meeting with different lenders, life insurance companies, Fannie, Freddie. So rates have ticked up, just with the treasuries being above 4%.
Yeah.
So anything inside of 6% is tough these days, unless it has like an affordability component where you have kind of naturally affordable units.
Mm-hmm.
So those types of deals is we would take a rent roll, plug it into like the local, average median income or area median income, and it'll spit out like, all right, those rents are kind of below market, and you get preferential pricing for that, and there's no kind of requirement that you keep it there. So yeah, it's kind of, it hits their Fannie and Freddie's mission goals. So we closed the deal last week at 5.84. But everything outside of that, banks, credit unions, everything's like 6.5 and up.
Wow, eh?
Yeah. So it's and the sentiment at the conference has been, it's kind of going to stick around like this, probably linger into 24. A lot of folks on the sidelines. So it's a tough market right now to make sense, unless you get like a good basis, like you purchase it at a good price.
Yeah.
There's some upside. That's kind of where we're seeing stuff getting done.
Hang
on 1 second.
Yeah.
I gotta order a drink at the RA bar.
Yeah, no problem.
Hang on 1 second. Hey, can I get that cucumber drink, the 30? Yeah, vodka, please. Sorry about that.
Yeah, no problem.
I'm waiting for my flight later, so.
Yeah, no problem. So are you seeing, lenders are, they're kind of holding off even as well?
They're quoting, but it just doesn't make sense when you're buying a 5.5 cap and your rate, 6.5.
Yeah.
Your cap rate's higher, or your interest rate's higher than your cap rate.
Yeah.
So if you can find a deal where you have like a 7 cap,
Jeez.
and we can get like a high 5s rate, that deal makes more sense. But
yeah.
when you have that lower cap rate than the interest rate, your proceeds are going to be at like 55%.
Wow.
LTV, maybe 60.
Wow.
Yeah, it's gotten. We picked up when the Treasuries dipped in July.
Yeah.
But since then, it went from like 3.7 to like 4.3, and it's kind of hanging around there. So it's slowed down since that. We signed up like 5 deals in that month, that like 2-week span.
Is that right, eh?
Yeah.
Man,
nothing since.
Is that right, eh? What a weird time, man. What a weird time.
Yeah.
This is
There's an opportunity.
Yeah.
It's good to have cash on the sideline.
Yeah, no doubt. Yeah. What are you seeing the big players in the market do right now? The big the big syndicators, the big portfolios, what are they doing? Yeah.
That side is not transacting a ton. Really, what's getting done is like sub 15 million.
Really?
And there's only a handful of deals. Thank you. I'm good. Thank you. There's only a handful of deals that are getting traded in like the big institutional range, and those are deals where maybe they did floating rate bridge debt.
Okay.
And they started at 3.5%, and now they're at 9%.
Yeah.
So there's some stress there, you know, and people are, if they've got the cash and kind of believe in the market, they can do it. But we're not seeing a ton of big stuff trade.
What are you seeing in the sub 15 range? Are people? Is this individuals? Or are these people that are
private clients?
Private,
1031 exchange.
Okay.
That's kind of the stuff that's getting done. Maybe they, are trading. They're out of depreciation on an asset, and they're trading into something that they can start that over. But like the people I reach out to, they're like, we're gonna wait till 24, and then the lenders are like, 24 might be, might be more of the same. So they're thinking like 12 to 18 months for it to kind of shake out.
Wow.
I think we'll see some more. We're going to be super busy at some point. I think rates will stabilize in like the high 4s to mid 5s. And I think when that happens, like people are going to, we have to have more pain in the economy. Like they're raising rates, and I'm in Vegas, and there's people freaking everywhere spending money. So there's just not like pain.
Interesting.
So if they lowered the rates now. Sorry.
What's that?
If the Fed lowered their interest rates now, inflation would just go back up, because they're doing it to see job losses, see people tighten the belt buckle, spend less money, and really it's like commercial real estate's the one getting hit the hardest, because everything depends on the rates.
Yeah. So, nobody really cares, right? You guys have. Why would anybody sell their home over there? You just keep it for When you got what do you got? 65% of the homes over in the U.S. are sub 4%.
Oh yeah. Everyone I know is at around 3. And what are you gonna buy a new house and then pay 7? Yeah,
whereas us up here in Canada, you'll term out maximum. The majority of people we're going to term out in 5 years. From 2 to 3 years ago. So, we're going to see that more than you. Which actually we just had a rate pause on Wednesday up here, and and every time that happens in Canada, man, the market just goes nuts. And I'm kind of curious to see what's going to happen there. But we're so sediment driven up here, it's crazy. But it was. I wanted to get a little bit of context, because I know you guys move some weight at your firm. So, I was kind of
down 70% from last year.
Are you serious?
Yeah.
Wow.
Last year was an average year for us is 12 to 13 billion.
Wow.
In loans, and 21-22 we did $23 billion each year.
Wow.
Because there was all that I don't know if you're seeing the guys that are the syndicators that are did all that floating rate debt, just bought like crazy in Phoenix and Vegas and Dallas. And the rates all went up and they're all screwed.
Yeah.
We did a lot of that business for them, and so all that bridge business is gone. So we're at $4 billion year to date.
Wow.
And last year we hit 22 last year.
Wow. So what's happening with those syndicates and their properties? What's going on with them?
Look up Tides Equities. Just Google them and look for news articles.
Tide?
Two young guys. Tides.
Tides. Okay.
Tides Equities. They are two early 30s guys, and they bought $6 billion in real estate in Dallas and Phoenix using rich people's money.
Wow.
And they did only floating rate bridge debt, which they were paying 3.5%. Now it's 8-9.
Oh my
and
God.
The rent in those markets is it's not going up, it's going down. So they have they're going to turn over billions of dollars in properties. Them, and then there's another group called Rise 48.
Oh, I heard about that. Yeah, Rise 48. That was next door to the Rise 48 had a property right next door to me where I was trying to buy that property in Phoenix.
Yeah. Place?
Yeah, exactly. Yeah.
Yeah. So those guys are in the same boat. He's like a young guy, syndicator, just came out firing and buying big deals, $40 million deals, $50 million deals.
Wow.
They're in trouble too. So
is that right?
There's a bunch of articles, and it's finally like made its way to like the Wall Street Journal.
Is that right?
But when it hits there, it's big
serious
time, and everybody knows. So those guys are going to feel a lot of pain. But they're like big institutional groups are kind of just waiting for that stuff to bleed. And I mean, these guys are going to the lenders aren't even going to get their loan amount back in the sale. That's how like far down the price of the building has gone.
You got to
be rates expanding, rents going down. They did call it a $50 million loan or $50 million property. They did a $40 million loan. It's probably worth like 35, 38 today.
Oh man,
so the lenders are going to get burned too. So
holy shit, dude.
Show, man.
That's so crazy. So a couple questions. Number one, rise and tides or whatever. As an example, what are they going to do? They're going to hand in their keys? Is that what those guys typically do in times like this?
It's all non-recourse debt, so they're not on the hook, and they, as syndicators, charged a acquisition fee, an asset management fee. So both those young guys at Tides and the Rise 48 guy, they're loaded, and they'll just be like, all right, here you go, lender, and it's non-recourse, just to the LLC. So they're not going to get hurt unless there's like some sort of, they have bad boy carve-outs. So if you any sort of fraud or you're like lying to the lender about rents or expenses, then that can trigger recourse and they'll be in trouble. But they're gonna hand back the keys. There's another one in Houston that it's called Apple's Way was the sponsor, and they handed back like $250 million in loans in Houston like 2 months ago.
Wow. So what happened? Like, what happens? Does the bank end up putting it back up on the market? What happens in that kind of case?
Yep.
Yeah, I would imagine. Wow.
People are still living there,
Yeah, I guess, right? Yeah, it's got to move.
And then someone else will come in and buy it,
Interesting. So you think
5% less than what they bought it for 2 years ago?
So you think there'll be a lot of opportunity like that coming up? Is that what your take is? Yeah.
Yeah, that's kind of what we're waiting for.
Interesting.
Still, a lot of cash on the sidelines.
Yeah. Interesting.
So it'll come back around. We're slow now, but as soon as kind of things stabilize and rates come down a bit,
yeah,
we're going to be slammed.
When do you expect? If you had to take a guess, when would you expect rates to start to stabilize with around in that 5% or 4.5% range that you think?
The sentiment here is like survive till 25.
Okay. Yeah.
So like 12 to 18 months.
Interesting. Okay.
But in the meantime, there'll be some deals that that someone paid $10 million for 2 years ago, and now it's on the market for 6 or 7.
Interesting.
And then when things, it's a cycle, and it's going to be like 2 years of this crap.
Yeah.
And then things will normalize and we'll be back again. Same with the Great Recession.
Yeah. So you think
be as bad as that, but
gotcha. So you think that even within the next 12 to 18 months, it's going to get worse over there.
Yeah.
Than it is now. Interesting.
Yeah.
Interesting.
Well, all this shit needs to just flush out.
Yeah.
Because it's here and they're trying to work through it, but it's the writing's on the wall.
Interesting.
And so you're going to see big headlines of deals getting taken back by lenders, and it's already baked. Like it's already going to happen. There's no going back.
Wow.
Let's flush out.
That's wild. So with these guys, like for example, Tides, Rise, what was there? So you mentioned Buddy and Tides raised $6 billion. Like over what kind of time period?
Like 5 years.
Wow.
They bought $6 billion. Yeah, it'll be in every article because they're like 33.
How how did they? What were they doing to? Do they have a lot of clout in the market? Did they come from something
They came from institutional shops. And
Okay.
they come from wealthy families in LA.
Okay.
So that's how they got their start. Like, their parents are super wealthy. And they know a lot of wealthy people. So that's how they got their start. And then their returns were like, 2.5 times multiple, like 22 IRR. Like, their numbers when things were good were great. But they were just like buying deals from each other, these syndicators. Like, buy it in 19 for 20 million and then sell it for 27 in 21 to another syndicator. And there's some more meat on the bone with units that are still not renovated, but there's proof that if you renovate the units, you can hit these rents. So they were just playing like hot potato.
Oh, okay.
Deals, mainly in like Vegas, Phoenix, and Dallas.
Wow.
Our San Diego's not as bad because we're so supply constrained.
Okay.
So we're not going to see that like in our market. And there's some other type markets like that, but the kind of boomer bust markets, that's where all this shit is going down. Because in good times, you can make a killer return there, but when it hits the fan, that's where you get all these deals that go sideways.
Wild, man. Wild. Okay, so on to my next questions or few questions that I have.
Yeah.
Canton Manor. So I'm gonna be. So obviously, I own majority of that property.
Yep.
Right now, we're doing some renovations on it. I'm going from every renovated unit within the range of like $10,000 to $15,000. They're not big. Doesn't take too much to turn these units over and really do a complete overhaul. I'm bumping the rents by about $200 per unit per month. So I'm getting some pretty good push on them. And but I guess the question that I have for you is, what I want to do is, I want to sell off my equity or a good portion of it, because I have a lot of it tied up in that property, and I have proof of concept on about 5 units that I have a waiting list at this point for that property. So I've got proof of concept with at least 10% of the property or the units in the building. But I don't know if I were to go to market right now and go to investors with that model, how are these syndicators, or how are these guys pricing in debt? Because I have a refi coming up in, I don't know, maybe a year and a half. I'm going to be refining that thing out. So I'm not exactly sure how to price that into, for investors in a pricing model. You know what I'm saying, or for like a pro forma or something. Like what do guys usually do? What would you advise?
Yeah. Like your operations are what they are.
Yeah.
And from a value perspective, it's just a matter of like how far the cap rate has widened in that market.
Mm-hmm.
So that's how what'd you buy it for?
3.35.
Do you remember the cap rate?
Oh man, the as is cap rate was probably it was in the 6s,
Okay.
Maybe 6.5. I want to say.
So what I would do is I would look at your
Maybe call it 6.
Yeah, I'd look at your T12 because you've obviously improved the income.
Mm.
So your NOI is going to go up. So that part of the equation helps. So I would look at your T12, and then I would pull. I can do this when I get back next week. I would pull market comps for what's trading and kind of what the market analysts are saying.
Okay.
And then you do that calculation for cap rate. Plug in the market cap rate divided by your NOI, and that'll spit out a value.
Yeah. Okay. Fair enough. Okay.
That's the easy way to look at it.
Okay. So basically, like comps, and like I guess, do you build in a rate based off of today? Do you build in a rate? Like I don't know where to go with the rate. That's the problem. Like that's the problem that I'm going with, right? Is if I put out a deck today for potential investors based off rates today, when I refi, and say for example, this particular investment is, I don't know, a 5-year term with investors, but I have a refi in a year and a half. That's more of the burning question is, should I wait the year and a half? Should I, but I want my equity out, right? I want my equity, but I have a refi coming up in a year and a half. I don't know exactly what, I guess players in this type of industry or syndicators or whatever would do in this circumstance, right?
Yeah. I mean, you have time. That's plenty of time. I think with like 6 months left, that's kind of a ticking clock.
Yeah.
So you're not kind of forced to do anything. And I think the more you wait, if you wait 6 months, now you got a year left. What the sentiment at this conference is as people get used to these rates, the cap rates are going to widen to adjust for that. And that's just how the market's going to be priced going forward.
Yeah.
So right now it's kind of in a weird time where rates have shot up and cap rates are starting to adjust to that.
Got it.
To your point. So like as rates go up in this new environment, your cap rates got to go up.
Sure.
Which is going to lower the value of the property just on, on paper.
Yeah.
But again, with your increase on the income side, it's worth more than what you bought it for sure.
Yeah.
Still, even with higher cap rates.
For sure.
But
yeah.
I think we just need a little more seasoning of this kind of environment for things to stabilize. And then you can run, an analysis on, all right, this is what market cap rates are. This is what our NOI is. This is what your return looks like if you were to, invest, take you out. And it's, you've got a good story. You've got a waiting list. You got renovated units. Is it senior, 55 and up?
Yeah.
Yeah. So, I mean, that's not going anywhere.
Yeah.
So from an investor standpoint, would you want to invest in something like that or like office, retail?
Yeah.
It's still like the safest of the real estate assets. So if you want to get in on that, that's the type of property you want to be in on. So
for sure. So if I came to you and I said, "Hey Connor, I'm taking this property to market to investors. I got a refi, I got a refi coming up in a year and a half." Would you say, Dan, just price in what market interest rates are right now?
Yep.
Okay.
Yeah.
So that's what these guys are doing.
Yeah.
Okay.
And then that impacts the cap rate. So that's how I would look at it.
Got it. So you would not price in would you do this? Would you price in the current rate that's on the property until that rate expires, and then would you price in, say, would you make
so advanced math of it?
Okay.
Be like, hey, I've got this rate for this amount of time.
Yeah.
And then this rate for the next 3 to 5 years.
Got it. Okay.
And then you do a blended.
Yeah.
That.
Got it.
And
okay.
So your blended rate's going to be lower than how you would analyze it at just fully market rate.
Got it. Okay. And then you would use for the tail end of that blended rate, you would use current debt rates right now.
Yep.
Okay. All right.
Yep.
That's what I'll do then. Okay. So you do about 6.5 on that property, you would guess?
Yeah.
Fuck me. That's crazy. I mean, at the end of the day, like, is it though? It's not really, right?
Yeah. Well, 3 months ago, it would have been 575. It's just everything's, kind of caught up. And who knows, like, I think we're going to go through a pause period. A lot can happen. And it's really like, I look at the treasury every day. It's the first thing I do when I wake up. And that's kind of our, indicator of how the market is. And a lot of things outside of the Fed raising rates and commercial real estate go into that, 10-year treasury, 5-year treasury, the inverted yield curve with the 3-year being higher than the 10 and 3. So it's the economy as a whole really that impacts that. So things can change. I think, our sentiment is this is kind of the new normal for the time being, but who knows? Yeah,
for sure. I'm trying to. I love time. Like, to be honest with you, I love times like this because they don't. It doesn't scare me.
Yeah.
And I feel like, my whole idea and my whole concept, my whole business plan really is you get in at a good basis and it doesn't really matter what happens all that much.
Yep.
Right?
Yep.
If the property is cash flowing strong, you get in a good basis, you're set, you're covered. Even if shit really hits the fan, you'll be able to weather the storm. The problem is like what you mentioned, sellers haven't adjusted their expectations and caps haven't gone up enough, right? So, but what I am starting to see is, increasing cap rates in tertiary markets. That's what I'm starting to see. I'm just, obviously in tertiary markets, there's not all that much going on, but I think I'm going to start really entertaining senior properties in these tertiary markets. That's what I think I'm going to start looking at. Do you guys ever do anything like that?
Yeah. We got sources for that, for sure.
Okay, and that's for those type of properties.
Like secondary, tertiary, like maybe like 100,000 population.
Well, let me ask you this. Obviously your deal's only as good as a debt, right? So, to some extent, what would you say would be a limitation of, where you start going into markets where, there's like a population of 10,000. Is that any kind of an issue for lenders? Will they look at that? Or
I mean, it's going to eliminate a lot of the like life insurance companies. It doesn't technically eliminate Fannie.
Okay.
Freddie would be out.
Okay.
Because you have to throw everything into like a pool with Freddie.
Okay.
For a securitization versus Fannie, which is just a single asset.
Got it.
But the pricing right now for Fannie below $6 million is like 50 bips higher than under $6 million. So if you're in like a 10,000, population town, it's probably a local credit union or bank, which we have access to.
Okay.
But yeah, it's going to be recourse, and you get the flex prepay. That's what kind of everyone's looking at these days.
Okay.
We're doing a lot of like credit union business because they have the most flexible prepay.
Okay.
People are assuming in 2 years I can refi out of this.
Gotcha.
But no, we would find a loan. It's just a more limited pool.
Sure.
And you might not get you're not going to get the rate of doing a senior deal in San Diego.
Got it.
You're also going to get a better cap rate than doing a deal there versus San Diego.
That's kind of the problem. And the cash flow is strong in these tertiary markets, and you might I'm seeing them in 20,000 population, stuff like that. But anything else isn't really papering at this point.
It's starting to.
Is it?
It's gonna come. Yeah.
Okay. All right. Fair enough.
It has to, and everybody in commercial, it's not like residential like we were talking earlier, where you have a 30-year mortgage and you can just sit on it.
Yeah.
All these people that own these properties, they have maturities.
Yeah.
Usually, 5-7 years, and those are coming. So the market has to turn over, and so the market's going to adjust more than like the residential market, where there's just no supply, and that's what's keeping prices up.
Yeah.
So prices are going to come down, cap rates are going to go up.
Fair enough. Interesting. Yeah, I just, at that point, will the competition start picking up again, right? And it's
but if you look at like the people who did deals in 2009, they crushed it. And that was like the height of the fear.
Yeah, I agree. Yeah.
So like you look back, you're like, shit, I wish I would have done it then. But when you're sitting in that time period, you're like, it's kind of scary. I don't know where things are going.
Yeah.
But if you can get a deal at a good basis, like that'll hold true. And if you do a 5-year loan, by the time the loan matures, you're in a much better place.
Right. I couldn't agree more.
Yep.
All right, man. Well, enjoy. You're leaving right now. You're in the airport, you said?
No, I'm at the pool at the Aria.
Oh, you're waiting on a flight today?
I changed my flight. It was at noon. I booked it at the last one out at 9:30 to
sick.
hang out.
Nice, man. Is there how's the talent there?
It's okay. I mean, where I'm sitting, it's okay, but like in general, it's very good.
Fair enough, man. Awesome. All right, buddy. Well, I'll Yeah, I'll keep in touch. It's kind of been a little slow on my end, but yeah, I'll keep in touch, and hopefully, I'm going to be looking at. I got a couple on my radar right now. So
for sure, yeah, hit me up anytime, and Wyatt and I will size it up for you and give you our feedback.
Awesome, thanks, buddy. Appreciate it.
All right, brother.
All right,
take it easy.
See it.
Bye.
There you have it, people. That is a very aggressive broker from a very successful $24 billion a year brokerage, as you heard him say. And that is, we obviously discussing the U.S. market. It's something that, I've kind of, I don't want to say put a pause on for Coachwood Capital, but it's something that I haven't been extremely active with because, like I mentioned to him, nothing's really papering because cap rates haven't adjusted with respect to what rates are doing. But, as you heard it from him in the horse's mouth, he expects, sellers' expectations to adjust. People are going to be terming out of their commercial mortgages fairly soon, and we're going to see what happens in the market.